Everyone has an opinion on whether you should buy dividend ETFs or growth ETFs. Dividends are safer, growth makes you rich faster. But I do not like guessing, I like calculating. So I went to the ASX data and pulled 10 years of history. The real choice is not just dividends versus growth, it is also Australia versus the US plus currency. I wrote a Python script to test Australia's most popular dividend strategy against the most common growth proxy Australians buy on the ASX. I'm not guessing what might happen. I'm calculating what actually happened. I use daily trading data underneath, but this dashboard shows clean checkpoints so you can see the gap without noise. And the results surprised me. We are not doing one single test and calling it a day. We are doing 5 same 2 ETFs, same rules, different stress test. If a strategy only wins in one perfect scenario, it is not a strategy. It is a coincidence. First, let's meet the fighters. On the left, for Australia, we have VHY, Vanguard High Yield. Big Aussie companies like BHP and Commonwealth Bank. Its job is simple, pay you cash regularly. On the right, we have IVV. It is listed on the ASX so Australians can buy it easily, but it tracks America's biggest companies Apple, Microsoft, Amazon. These companies do not focus on big dividends. They keep more profit inside the business to grow. Here are the rules. No opinions, no stories, just an account balance. Start with the same money, buy, hold, track. We start with a hypothetical investment of $10,000. My code takes this money and buys both funds 10 years ago. It holds through everything inflation, COVID, war, and rate hikes. And I test it in two modes because this is real argument people have. Mode 1 is wealth mode. Reinvest every dividend dollar back into the fund. Mode 2 is income mode. Spend the dividends and only track the portfolio value plus the cash you actually received. Place your bets now, dividends or growth. Test 1, lump sum. Wealth mode, reinvest dividends. This is the cleanest compounding test. Look at the first few years. It is incredibly close psychologically. Dividends feels great here. You see cash hitting your account, you feel safe. Early on, VHY can keep up. If you stop the test here, you would say why take the risk on growth? It feels real, it feels tangible, but then the timeline shift. Watch the blue line around the middle of the decades. This is where compounding starts to separate the stretches. While Aussie companies pay out more profit, the US giants keep more profit and reinvest it into growth. By year 8, the gap is obvious. And this is the key concept. Is the dividend strategy bad? No. If you need income now, it can be perfect. But if you are building wealth for tomorrow, you can be paying a safety tax. You trade future upside for the comfort of today, and the math shows that comfort can be expensive. Now, do not look away because this next part is where people argue past each other. They compare a dividend ETF in the spend mode to a growth ETF in reinvest mode, and then they act surprised by the answer. So, we will do it properly. Test 2, income mode. Spend dividends, track two numbers for VHY, portfolio value, and cash paid out. In income mode, VHY should look better because it is designed to pay you. So here is the question I actually care about. If you spend the dividends, does VHY still protect you or does it just slow you down? But there is a hidden boss fight in this comparison. Australians are not just buying US shares, they are also buying US dollars. So let us measure that instead of hand waving it. Test 3, currency attribution. How much IVV's result came from US share returns and how much came from Australian dollar versus US dollar? Most people talk about currency like it is a vibe. The Aussie dollar might go up, that is guessing. I want the split. On this screen, the blue result is IVV in Australian dollar because that is what you actually own. Then I add a second internal line IVV in USD. As if the currency did not move, the gap between those lines is currency. This matters because it changes the story. If IVV wins mostly because of the currency, you should think differently than if it wins mostly because of US companies outperform. And we can calculate it. Here is what this tells you in plain English. Buying IVV is not just choosing growth, it is choosing global earnings and accepting currency savings as part of the ride. Sometimes currency helps you, sometimes it hurts you, but it is always there. Now, 1 decade can still be a trap. What if you started the wrong time? What if you started right before a crash? That is sequence risks. So let us try remove the cherry picking properly. Not with 3 start dates, with every start date. Test number 4, rolling windows. Every possible 5-year period and every possible 3-year period inside the decade. This is where the video becomes useful. Because instead of one start date, we get a distribution, a win rate, and a worst case gap. First, the win rate. Out of all rolling 5 years windows, how often did IVV beat VHY? Then 3-year window. Short windows are harder. They are more chaotic. That is the real world. People do not always hold for 10 years. Second, the spread. When IVV wins, does it win by a little or a lot? And when VHY wins, does it win by a little or a lot? This is the difference between sometimes win and win in a way that changes your life. And again, I am not guessing, I am calculating. On this histogram, the center tells you what is normal, the tail tells you what is painful. If you are a dividend investor, you care about the left tail. If you are on a growth investor, you care about the drawdown and the recovery on the right tail. Which brings us to the most practical test of all. Most people do not invest in one single lump sum. They add money every month. So let us do that. Test number 5, dollar cost averaging. Same decade, same two funds, but instead of $10,000 month, we invest 1,000 every month. This test matters because it changes the emotional experience. If the market crashes, a monthly investor is buying cheaper prices. That can reduce regret and reduce timing risk. Watch the dashboard switch. Total contribution tick up each month. The lines move differently, and at the end, we compare final balances against the total money added. That gives you clean return on effort. Now, before we reveal the final scoreboard, we need one more metric that most people ignore until it is too late. Not total return, pain, risk check, maximum drawdown, and time to recovery. This is the cost of staying invested. Max drawdown tells you the biggest percentage drop from peak to trough. It tells you how hard it was to hold, but it does not tell you how long you were underwater. Time to recovery does. A strategy can have a big drawdown but recover quickly, or it can have a medium drawdown and stay down for years. If you are investing for wealth, recovery speed matters. If you are investing for income, stability matters. Now you can see it clearly. VHY was smoother, IVV dropped harder. That is real. That is the price of growth. But then the recovery tells the second half of the story. And now we can stop arguing with vibes because we have 5 tests, 2 modes, and real risk matrix. So, what is the final damage? Final scorecard, 10 years lump sum wealth mode. Reinvesting dividends VHY turns 10,000 into about 25,000. That is a strong result. But IVV takes it to about 42,000. Same starting money, same time period, different agent. That is about a $17,000 gap. Then we check income mode. We separate portfolio value from dividends paid and we add them back together to get the real benefit. This is where dividend investors get a fair test and we can quantify the cost of spending income today versus compounding for tomorrow. Then we check currency. We split IVV into US market return and FX contribution. No guessing, a clean breakdown. Then we check rolling windows. We measure win rate across all start dates, not just one. Then we check monthly investing because most people are not lump sum investor. Then we check monthly investing because most people are not lump sum investors. Here is the only conclusion I think is honest. If you need income now, high yield can be a practical tool. It can reduce stress and deliver cash flow. But if you are building wealth and you can handle volatility, the long run compounding engine has been stronger in this decade. And the math shows the safety tax is real. Now, a lot of you have asked about simple two fund portfolio, combining VS and VGS. Next video, I am running the same engine VS plus VGS versus a pure US portfolio, plus a hedge fund versus unhedged check. I want to see if diversification helps you or if it quietly clips your return. If you want the results, subscribe. I will see you in the next one.